Hi guys, in this video we're going to be talking about my investment account, what funds are exactly in them, and how I plan to use them to achieve financial independence. If you haven't already, check out my plan for financial independence to see what my exact goal is and how much I need to put away each year to get there. Also, be sure to check out my 1 year update to see the progress that I've made so far. The first place that I'm going to be investing in is my retirement accounts, and these include the usual, so 401k, IRAs, HSAs, etc. Currently, my retirement accounts are 100% in stocks. About a month ago, they used to be 90% stocks and 10% bonds. But because the returns on bonds are so low, especially in this inflationary period, I decided to just go 100% stocks. And the reason why I can't afford to be this aggressive with my retirement accounts is because I don't plan on needing the money until a very long time from now. And of course, my risk tolerance is pretty high. I don't actually plan on quitting entirely. I just plan to decrease my hours to half time, so essentially part-time. That way I have more free time to enjoy the things that I actually like to do, which is, example, make YouTube videos and travel, etc. So all of the stocks in my investment portfolio are in mutual funds or index funds, and these are just eventually baskets of stocks that share some similarity usually. And I don't invest in individual stocks at the moment just because of my need to be diversified and the fact that they can be risky than groups of stocks, but I may choose to invest in individual stocks in the future once I have additional money or feel that I can afford to take the risk. So I have several retirement accounts from different jobs over the years, but they all end up having the same amount of funds. And those funds are a large cap fund, the S&P 500, international funds, the total US stock market, mid cap funds, small cap funds, and then most recently real estate. And these probably all sound familiar because they're in most investment portfolios for retirement, except of course usually real estate. So as I mentioned, that was a new addition, and the way that came about is because I have a brokerage investment account, which I'm going to be talking about soon. But the real estate exchange traded funds, or REITs, so real estate investment trusts, they pay out pretty significant dividends, and those dividends are taxable if they're in a taxable brokerage account. So in order to avoid the tax implications, I move them to my retirement account, so my 401k, because I don't have to pay taxes on any dividends in that account until I retire. And presumably I will be retiring with a lower income than I have now, so that's why they're in the retirement account. Another side note about REITs is that they have been performing exceptionally good, except for most recently because the entire stock market is down, but they provide pretty great returns, like I said before, and I find them to be a better investment at this point in my life than physical real estate, because I don't have to deal with, all that goes into real estate, but I get the benefits of having investment returns and dividends. Now we're going to move on to my taxable brokerage account, which is a little bit more interesting. I definitely spend more time investing in this account versus my retirement accounts, which are all effectively passive. Like, I have set a certain amount to go into my retirement funds every month when I get paid, and that stays the same until I feel the need to rebalance. But the taxable brokerage account, I pick and choose what funds I want to invest in based on what's happening in the market at the time that I'm investing. So once again, my brokerage account is 100% stocks, and because it's not an actual retirement account, I can withdraw from it at any moment in time. I probably have to pay taxes on whatever amount of money that I have gained, so capital gain taxes, but I don't have the penalty of withdrawing from a retirement account like I would if I took money out of my 401k. So this account is something that I would take money from if I happen to need it in the next 30 years, because 30 years from now I will probably be in the age bracket to officially retire and take money out of a retirement account. So the accounts that I'm going to talk about are all mostly exchange traded funds, so ETFs, and they're by Vanguard. You can also get similar funds from Fidelity, and you don't have to have a Vanguard account to buy these exchange traded funds. You can buy them with any brokerage account such as Robinhood. So the funds in this particular account are consumer consumer discretionary, so things that people like to purchase with their disposable income. Consumer staples are things that you need normally, like household products, like companies that provide that. Then the extended market, which is anything outside of the S&P 500, so the top 500 US companies. Healthcare, which is self-explanatory. High dividend yield, which are just companies that provide a high amount of dividends to their investors. Information technology, so just tech stocks. I have also the international dividend appreciation, which is just international companies that are expected to increase their dividends over time. Materials, which are companies that produce or manufacture things. So let's see, for instance, paint, some commodity of some sort in that way. And real estate, so that's what I was talking about before. So those are the real estate investment trust, which, like I mentioned before, I have switched over to my retirement accounts, but I still have some in my taxable brokerage account from before I knew about the tax implications. So that's just a lesson that you live and learn over time, and you just adjust like after the fact. Other exchange traded funds that I have are the financials, so financial companies, the Russell 2000, so 2000 low value companies, as in comparison to the top 500 companies. These are the bottom 2000 companies in the US. And then the total stock market, and this one is actually a mutual fund. So this is VTSAX, which is a pretty popular mutual fund that people in the early retirement community like to invest in. So out of the stocks that I mentioned just now, the ones that pay the highest rate of dividends are the high dividend yield fund, of course, consumer discretionary, and real estate. If you're one of those people that enjoy getting dividends every month that you can live off, then those are the funds for you. But personally, at this point in my life, I don't like the tax implications of them being in this particular account, so I don't contribute to them anymore, but the dividends that I do get from them, I reinvest into the other stocks that I mentioned. And the reason I haven't sold them so that I don't have to deal with the dividends at all is because anytime you sell anything in these taxable accounts, then you're liable to pay capital gains tax, and I don't want to pay that. Now, if my income decreases in the future, then I may sell them then when the tax implications are not as high. So currently the top performers in the group of stocks that I mentioned just now are the consumer staples, which has returned 4.62%, the high dividend yield, which has produced 2.81%, and then materials, which has gained 1.63%. All the other groups of stock that I just mentioned in my taxable brokerage account are all in the negative this year, and that is in line with the total stock market, which is down 7% this year as well. If you want to gain more insight about how I go about buying stocks, then check out my payday routine. I have a timestamp specifically for that if you don't feel like watching the entire video. So that completes my investment accounts and what I choose to put in them. Let me know what your investment strategy is so far. Are you planning on retiring early, or are you content with your job at the moment? Let me know in the comments below, and I'll see you guys in the next video.